makers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Tom McKenzie here in London. Here's what's coming up on today's programme. European stocks open higher after the ECB's Governing Council member Olli Rehn tells Bloomberg that 2 more rate cuts may be in store for the euro area this year. Rivian shares rocket in post-market trading as Volkswagen says it will invest $5 billion in a joint venture with the EV maker. Plus, at least 5 people have been killed after anti-government protests in Nairobi turned violent, with anger directed at the president's tax-raising plans. European stocks were lower in the session yesterday, ending down 0.2%, but it's a solid session so far for European stocks. Gains are coming through, as you can see, for the FTSE 100. Currently, that index posting gains of 50 points, up 0.6%. Over in France, gains there as well. The CAC currently up 0.5% as we lead up to the first round of voting in that parliamentary poll on Sunday in France. Decent gains for the German DAX as well. The DAX currently at 18,359, posting gains of 182 points. Let's flip the board and have a look at the US futures story. Of course, you had the gains coming through on the S&P, but more notably on the Nasdaq yesterday, lifted by the gains coming through from Nvidia, buying the dip, it seems, after the $430 billion rout in that stock. Moving into correction territory, that has rewound. Gains for Nvidia of around 7% by the end of the close yesterday, lifting, of course, the broader S&P, but the Nasdaq as well. S&P futures looking to build on that, pointing higher by 0.2%. Nasdaq futures looking to add 89 points so far in the session. You can see there, of course, the gains across the European space so far in this session have gone 1 hour into the trading session. In terms of what's happening on the corporate front, one of the key stories for us is, of course, this investment by VW in Rivian, the EV maker, of course, in the US. It has struggled in terms of funding. It's struggled in terms of building out factories to get those cars into the hands of consumers. And, of course, the broader slowdown in growth of sales of electric vehicles for the industry. All of that being a challenge. VW now coming through with this significant investment. The initial $1 billion followed by a commitment of a further $4 billion into Rivian. And the shares gaining, of course, on Rivian pre-market on the back of that deal, up 43%. Significant, of course, for that EV maker in the US. In terms of what's happening, of course, within the delivery space, and this is a gauge, really, in terms of the health of the US economy, FedEx issuing a profit forecast above Wall Street expectations. Really solid numbers coming through from FedEx, boosted by the cost-cutting that's come through from that business. Also saying it would buy back $2.5 billion of its stock over the next year. FedEx then, pre-market, up 13%. We felt that in Europe as well, with Deutsche Post lifted, the last time I checked, up about 3% in expectations that Deutsche Post DHL will also get a lift, given the upside we've seen from FedEx. So pre-market, that stock rallying 13%. Now, the chief executive of Barclays says it is unrealistic to expect banks to abandon clients in fossil fuel industry. CS Venkatakrishnan says oil and gas will remain part of the global energy mix. He spoke to Bloomberg's Anna Edwards at the Bloomberg Sustainable Finance Forum here in London.
We are very much moving away from coal to oil, oil to gas, gas to clean energy.
Okay.
And the reality is that for quite some time, fossil fuels will be with us, right? Especially natural gas. So that glide path is long. And the world economy cannot go cold turkey on this tomorrow. That was the commitment we made. And we made a statement of how aggressively we were going to do it. And we've laid out these targets. We've laid out our measures. People can judge us by it. And we will report.
OK. And then what's been the response then? Because you mentioned you're subject to the push and pull.
Yeah.
And I imagine that's the case. So some of your critics will want you to go cold turkey on all of these parts of the energy mix. And others will say, no, you're leaving money on the table. So what's the response?
So I'll tell you the push and pull first. So in roughly the same 2 to 3 week period, in January, February, the state of Texas banned us from doing municipal bond business because we were too green. State of Oklahoma followed. I'm watching what Mike said about Florida and their fair access laws fairly closely. We have a retail business in the United States as well, credit card business, in addition to our investment banking and trading business. So it affects us. So in January, we get that. And then in February, about 2 or 3 weeks later, we get a consortium of UK universities, 1 or 2 of whom have been clients of ours for 250 years, saying that they didn't want to do business with us because we were not green enough. Okay? So you have that push and the pull across the Atlantic. More interestingly, a major financial newspaper based in New York, which is global, covers Texas, but not what happens to us here. And a major financial newspaper based not that far from here covers what happens to us in the UK, but not in Texas. Right? So not only are there multiple actions, different actions in different jurisdictions, but also it feels like we are playing to audiences and a world community which does not compare and contrast.
Barclays CEO CS Venkatakrishnan speaking to Bloomberg's Anna Edwards. To central bank policy now, an ECB Governing Council member, Olli Rehn, has exclusively told Bloomberg that investor expectations for 2 rate cuts this year are fair. Let's get more from Bloomberg MLive's Ven Ram. Ven, great to get your analysis, as always, in terms of the central bank speak. And the comments from Olli Rehn appearing to lift the equity markets in Europe. The euro as well under a little bit of pressure so far in the session. What do you make of what we've been hearing from Olli Rehn? Is it reasonable to you 2 cuts from the ECB this year?
Thank you, Tom, and good morning. I think that, it certainly is reasonable, but I don't know if it's likely. And I would like to make a distinction there because, if you look at the ECB's latest monetary policy projections, they raised the inflation for HICP inflation forecast by 20%, 20 basis points in June. That was already in a revision to what they had envisaged earlier. And if you look at GDP growth as well, they've raised it higher as well. So, the room for rate cuts, especially in a scenario where the Fed is reluctant to cut, is going to be very high for the ECB to keep going. So I think that 1 rate cut is looking more likely this year than 2 rate cuts. But, the ECB will want to keep rates reasonably restrictive until it knows that inflation is converging to 2% for sure.
OK, so 1 rate cut may be more realistic. Euro-dollar currently down 0.2% at 106, just shy of 107. Then, on the currency space, then the Japanese yen firmly in focus once again, as it has been, of course, this week. In terms of the currency over in Japan, 159.88, so a little softer in the session, down 0.1%. We have the inflation data out of the US on Friday. Talk to us about the dynamics playing through the yen. We've got some quotes coming through from the latest Bloomberg story, talking to analysts saying it would be crazy if the Japanese minister, finance minister or officials there stepped in, intervened before the inflation data of Friday.
Well, at the moment, the yen is seemingly well behaved, and there is little incentive for policymakers to step in and do something yet. But on Friday's PCE, I think there is a high chance that we'll get a print that matches the market's outlook. Why do I say that? Because we've already got the headline inflation and core inflation data for May. We've got the PPI data. Given those 3 sets of inputs, I think you can extrapolate the PCE, core PCE, to a very high degree of certainty, and that will show a moderation. So the markets are already priced and discounted for this. So there may be some knee-jerk volatility around the data, but I don't think it's going to be so discerning as to send the yen tumbling a whole lot. So I think that maybe, just maybe, the currency authorities in Japan may be thinking they may not need to intervene this week.
OK, well, we will continue to watch that story and see how it evolves, of course, in light of the personal consumption expenditures of the latest inflation data, of course, out of the US on Friday, and how that ties in with what's happening, of course, over in Japan, with the yen continuing to be in focus. Bloomberg MLive's Ven Ram with the analysis on that story. Just recapping what's happening pre-market for Rivian on the back of the story that Volkswagen, of course, has stepped in. Rivian shares jumping after VW announced plans to invest $5 billion in a joint venture with the EV maker. You can see the gains there. Wow, 40%, a little over 40%. Let's get the details with Bloomberg's Elizabeth Berman in Munich, who, of course, covers the auto sector, particularly that of Germany, in granular detail for us. Elizabeth, what are Rivian and Volkswagen planning then in terms of this deal together?
Yeah, absolutely. So they're setting up what will become a 5 billion venture to work together on an EV and software platform. And what VW is getting out of this is Rivian's expertise in this field. They're widely seen as the next best competitor in terms of technology to Tesla, of course. And VW has some very well documented struggles in terms of regaining momentum in the EV space after running into a lot of trouble with doing it all in-house. So both of them can glean some significant advantages here, but there are some risks involved, of course, as well.
Does it, from your understanding, Elizabeth, where you sit and you monitor, of course, you understand VW in such great detail, does this deal make sense for them? Does it make sense for Rivian?
Like I just said, I think it makes a lot of sense for both. I mean, VW is in a tough spot. They're such a significant car maker, but they've really fallen behind in getting on top of the EV transition. They have had several model delays after their software efforts largely went off track. They're falling behind in China, again, also partly due to their failure to come up with models that inspire EV buyers there. And then they're also very much dependent on China, overly dependent on China. So they're trying to build the US footprint, which the Rivian deal partly achieves if it comes off. As for Rivian, we know they're heavily loss-making, and that's really a concern as we've seen the EV demand slow so much, with customers still worried about taking the plunge on very expensive, comparatively so, vehicles amid patchy infrastructure and so forth.
Elizabeth Berman, thank you very much indeed. Joining us from Munich on this tie-up, this deal, worth about $5 billion between Volkswagen and Rivian. Just briefly getting you up to date on what's happening within the banking space. You've got a pop in the shares of Danske Bank, currently up 2%. This is on the back of an upgrade, profit upgrade following strong credit quality is the line coming through from Danske. And the redhead is that Danske Bank now sees full year net of around and between, this is the range, 21 to 23 billion Danish kroner. That is up from a range of 20 billion to 22 billion. That has been upgraded, and again, profit upgrade following a strong credit quality assessment coming through from Danske Bank, and the shares popping on the back of that. Coming up, France's snap election takes a toll on that country's banking stocks. We will do a deep dive in terms of how Europe's banks are faring amid the political risk and expectations of lower rates. This is Bloomberg. Welcome back. Checking on the Danske Bank, the stock there currently up 1.6%, getting a pop on the back of an upgrade to its full-year views in terms of net income. And again, talking about strong credit quality across its portfolio, the profit upgrade following strong credit quality at Danske Bank. And that is a theme that we want to follow with Christopher Hallam, head of European Financials Group at Goldman Sachs. Really timely to have you in the studio, Chris. Thanks for coming. Thanks for coming in. Talk to us about credit quality then. It surprised many that credit quality has held up broadly across European banks in spite of this higher rate environment, in spite of the inflation concerns. Does the Danske Bank story talk of a wider theme, and does that continue? Does that have legs still?
Well, first of all, Tom, thank you so much for having me here today. Look, I think it's a really interesting data point. Just a few weeks ago, we hosted about 100 financial institutions at our conference, and one of the key messages actually coming out of that event was that credit quality that investors and banks themselves had assumed may normalise higher. It's been lower, as you said, for quite some time. Actually, there doesn't seem to be a clear indicator that is going to get worse anytime soon. And in fact, several of the CEOs were saying, if you think about the de-risking that's happened on bank balance sheets over the last 3, 4, 5 years, shifting into less risky areas of lending, non-performing loan ratios coming down, that then feeds through to all else equal, a lower kind of credit cost on a through-cycle basis. If you couple that with the margin slightly better macro conditions in Europe, it wasn't so long ago we thought Germany would be heading into recession. So if you tie those two things together, then yeah, it's logical that actually we may see a better for longer sort of backdrop more broadly across the sector, but specifically within credit costs.
And I guess some would say that the flip side of the credit quality story, as we see the door opening, of course, from the ECB to rate cuts, and Olli Rehn telling us maybe an additional 2 rate cuts coming this year, that presumably gives some reassurance to those who might be concerned about credit quality, maybe eases the pressure on that front. But in terms of net interest margins, some may suggest that that's going to be a challenge. The European banking space, European stocks up about 30% or something year to date. Is there resilience for these European banks in an environment of lower rates?
So I think it's a really interesting segue, because a year ago, if we'd had this discussion, the risk was that having rates at 4% for an extended period of time may start to cause some cracks in areas of later cycle credit risk. Think about commercial real estate, consumer finance, for example. And that hasn't really happened. There's been some idiosyncratic examples, but broad-based, actually the situation's been pretty good. Then if you flip over to what it does on the revenue side, I think what the banks have been able to illustrate to people so far this year, and part of the rally that you talked about, has been driven by the fact that they've been able to get people comfortable that the NII sensitivity over the next 2 years, as we normalise down, we have 2 cuts this year, but through next year as well, that we normalise down to a lower terminal policy rate, that actually the banks are in a pretty good shape in terms of NII. Now, if you dig into that, to give you some idea, it's not just rates, right, in terms of NII. We've got volume growth, which I think people are becoming more constructive on for next year in particular. You've got the benefits of the hedging that they've already done. And then if you isolate the rates impact, there are other levers the banks can pull in terms of deposit funding costs. And so therefore, when you look at wrapping that all together in NII, I think that at the margin, some of these guidance points, and you talked about Danske, but some of the others as well, have been slightly better over the last 3 to 4 months.
What does all of that mean for the return of cash to shareholders, dividends, buybacks, which has been a theme that banks in Europe have been able to ride? Does that start to be challenged in that environment, or does that have legs as well?
So I don't think it is challenged in that environment. Look, I think the environment we're talking about for European banks right now is what we call a better for longer backdrop, right? Rates are coming down, but to a level of 2.5%, let's say, for the Eurozone. That's much better than where they were, right, when they were minus 50 basis points. That's good for bank economics. As you feed through the P&L, you also have a better outcome in fees. You have a more, predictable outcome in terms of OPEX and regulatory costs, and that means earnings are more predictable, we would say, over the next 2 years than they have been maybe over the last 10 years. Returns, therefore, have reset higher. You talked about the 30% rally that we saw at the beginning of the year. A lot of that was baking in this better operating environment, this better for longer backdrop. Now, when we look specifically at distribution, to put some numbers on it, the average European bank that we look at will be paying you about a 7 or an 8% dividend yield, and then augmenting that with around a 4% buyback yield, i.e. buying back 4% of the stock each year. This year and next year, if you isolate in a bank's P&L the impact from the ECB rates coming down, it's about an 8% earnings hit over 2 years, coincidentally the same as the 2-year stacked buyback. So the nutshell is the buybacks insulate earnings from the rates normalisation.
OK, really interesting. French banks down, some of them down double digits, of course, since that surprise announcement by the President Emmanuel Macron around the parliamentary vote. Do you buy French banks? Is this a buy the dip opportunity? What do you do with French banks?
Well, I think it's what's happening right now versus where are the fundamentals, right? So in the economic system we have, political uncertainty is macro uncertainty. And there are different ways that we can think about that. But mechanically, if you look at the French banks today, what you've seen is, OAT spreads widening versus bonds, but also just increasing in absolute terms. That has a mechanical impact in terms of funding costs, in terms of cost of equity. But a lot of these banks are reasonably well diversified, and so they would be insulated from that. If you also rewind maybe 10 years and think about the sovereign crisis in Italy, we don't have that same sovereign bank nexus in terms of spreads as we had in Italy, in France today. And so actually the banks are relatively insulated from that from a capital perspective. Now, is this a buy the dip opportunity? I think you therefore have to have a view on politics. So there's probably lots more people better qualified than me to talk about the politics in France right now. But clearly the fundamentals of the European banking sector are actually in great shape.
OK. Concentrate on the fundamentals as well as trying to get an assessment of the politics and how the politics of France is evolving. When you're thinking about the banking space, Head of European Financials Group at Goldman Sachs, Christopher Hallam, thank you very much indeed for the analysis across the European banking space and some of the reasons to stay long at least parts of that sector. Coming up, the leaders of France's, talking of French politics, France's main political groups clash in a heated television debate, first of its kind for this round of the vote. We're going to take a look to see if their arguments have landed with voters ahead of Sunday's first round poll. This is Bloomberg. Welcome back. Now, with just days to go before France votes in the first round of its parliamentary election, leaders of the 3 biggest political groups have clashed in their first televised debate. Let's get more from Bloomberg's Caroline Gonat. Caroline, what for you were the key takeaways then?
I wish you heard from the debate itself, but I can tell you that each of the 3 candidates had about half an hour each, and they clashed a lot on the cost of living, on the pension reform, which was, of course, one of Macron's major reform last year. Bardella saying that this pension reform has been useless and inefficient, and we should bring back the retirement age back to 62 years old. Manuel Bompard from the far left saying it should actually go down to 60 years old by 2027. That was one of the key clashes between the three. Bompard also, of course, was questioned on how he's going to finance the really costly program from the far left. He said he's going to tax the 8% richest people, those who earn more than 4,000 euros.
Caroline Conard, thank you very much indeed with the analysis on the debate in France. Coming up, we're going to speak with the head of Canada's largest pension investment fund as the sector tries to cut its losses from slumping real estate markets. That conversation is next. This is Bloomberg. European stocks open higher after the ECB's Governing Council member Olli Rehn tells Bloomberg that 2 more rate cuts may be in store for the euro area this year. Rivian shares rocket pre-market as Volkswagen says it will invest $5 billion in a joint venture with the EV maker. Plus, at least 5 people have been killed after anti-government protests in Nairobi turned violent with anger directed at the president's tax-raising plans. Good morning and welcome to The Pulse. I'm Tom Mackenzie in London. Now, investment managers are warning of great opportunities but also challenges ahead for the $1.7 trillion private credit market. Some of them gave us their thoughts at the Bloomberg Invest Summit in New York.
We think there's a big opportunity in credit.
There is huge investor demand.
Because the returns are higher, now everybody wants access to it and is trying to get into it at the same time.
The credit cycle is quite mature.
What we want to do is just be all things credit.
We do expect there to be some challenges ahead.
Private credit has been touted as this amazing thing, almost like NFTs or, ChatGPT.
I don't think that the boom in private credit all of a sudden suggests that private credit is bad asset class.
I think it would be impossible for us to ignore private markets and not think that there's a large opportunity set.
We don't think the very record tights that we have on credit spreads are reflective of some of the real challenges we have in the economic backdrop.
I look at it like this amazing force that will have hiccups in the years to come.
OK, leaders in asset management, banking and wealth weighing in on private credit. Now, Canada's pension plan, or the Canada Pension Plan, CPP, the country's largest, earned an 8% return in the fiscal year to March, driven by its exposure to stocks, credit and private equity. It made up for weaker performance in emerging markets and real estate. Joining me now is John Graham, Chief Executive of CPP Investments. John, great to have you in studio. Thanks for coming in.
Thank you for having me.
Let's start with this question. Across your investment strategies, where are you finding the most value right now?
Where are we finding the most value? I think one theme as we look around the world and look across asset classes is there's probably no safe harbor. I think we can get a little bit worried about almost every asset class and geography and worry about it. But as a long-term investor, I think part of our thesis is develop a long-term portfolio construction approach, allocate to the asset classes, geographies you want to be in, and stay actually invested in those asset classes and geographies over time. Right now, where we're probably seeing some of the more interesting opportunities, private credit is a big topic. We've been in it for a long time. I used to run the credit department. We'll continue to invest in private equity, continue to invest in public equities, and we'll continue to diversify vintages in private equity.
OK, I want to break down some of that. Before I get that view in terms of not finding any safe harbours at this point, with that long-term investment horizon that you and the team obviously have, do you have the necessity? Do you need to look at hedges in this environment, or you can look through some of that uncertainty?
Yeah, probably a way to think about that is even with currencies. And we actually don't hedge currency to any great degree in a view that over the long run it's just a cost. So we take that volatility. Having a long-term horizon, having a 75-year time horizon, we actually can wear that volatility over the near term with the view that we minimize the cost over the long term.
Do you worry about your exposure to real estate and then the broader slowdown across that part of the market?
Yeah, we've been in real estate pretty much since inception. It's probably one of the early asset classes we got into. You can see from our results, our real estate's been flat, let's say, over 5 years. But you got to unpick it. And we've certainly taken some hits in office, specifically in North America. But that's been offset partially by our Asia Pacific portfolio, partially offset by logistics, by data centers, which have done reasonably well. I think the question for office, as we look at it right now, is certainly taking some hits in the portfolio, but where's the bottom and when will it be an opportunity to buy?
Well, what is your take on where the bottom is for commercial, for office? Are we getting closer to that point? How do you see that story evolving?
Yeah, I think with respect on the real estate side on office, there's probably some trends in the market that make it difficult to think about the bottom and think about exactly where we are, the trends of remote work, where that's going to land, densification of the office, where that's going to land. But the team continues to look at what they would consider to be the high-quality properties and continue to have partnerships with different developers around the world. When
it comes to private equity, then, we've seen a slowdown in returns in terms of PE as well. Do you want less exposure to that asset class at this point?
No, we don't want less exposure. And with respect to private equity, I know people use the term alternative asset class. We kind of think that maybe that's a bit of an antiquated notion, that PE is equities, and it provides a different governance structure in the private equity. And again, we have ample liquidity, so we can be in a position for a longer time. With private equity, again, we've been in it for a long time, and certainly one thing we've learned is the importance of being pretty disciplined in vintage diversification. Don't get too excited in any vintage and don't get too down on any vintage, and just try to be almost programmatic in investing every year.
Do you have a view in terms of when private equity and the returns more generally, more broadly across that space start to turn around?
Well, I think with respect to returns turning around, I don't know, it's difficult to forecast returns.
Yeah.
I think certainly something we see through our portfolio and through our activity, it's just been a little bit slower over the past couple of years. Been a little bit slower. There's certainly a lot of activity in the 2021 vintage, a little bit slower now. We're seeing less distributions coming back, less activity. I think we'll have to see that activity start to pick up and kind of that bid-ask spread narrow in the market.
Which are the most investable private equity firms right now?
Oh.
Put you on the hot seat there.
Yeah, put it on the hot seat. So we have had long-standing relationships with the large global private equity firms. And for us, for the scale we have, it really works well to be partnered with the big firms where we have relationships beyond private equity. We have relationships in credit. We have relationships in real estate. So the big global firms are ones that we continue to deepen the relationships with.
Do you feel like you've got, in this funding environment then, does the leverage arguably falls to the LPs, so to you in this respect? Does that allow you to push for kind of special discounts and some changes, some alterations in terms of the relationship, in terms of the deals that you're pushing through with these GPs? The leverage is with you. Are you getting some discounts on things like fees?
So the way I would think about the partnership approach that we have with the general partners is we've had long-standing 10, 15 plus year relationships with them. So you don't wait for the bottom to try to extract a couple basis points. We have long-standing relationships, partnerships where I think we have very equitable and strong partnerships with the big firms.
How are you thinking about direct investment? Is that becoming more important for you and the group in terms of an opportunity? Do you want to be more proactive in terms of direct investing?
We'll talk about private equity, and we run, let's say, our energy program, our infrastructure program a little bit different. But on private equity, we run a partnership model where we have a large funds portfolio where we're an LP with some of the biggest GPs in the world. And then we do co-investing, co-underwriting with the GPs. And that's worked really well. I mean, the returns have been very strong for a long time, and that model has worked very well for us. And we'll continue to execute on that model.
I want to loop back to what you were saying about commercial real estate, and particularly the office space, and we're thinking about work from home and how that whole story evolves, and there's obviously a lot of uncertainty there. You mentioned data centers as well, and I was speaking to the CEO of a data center business. They're looking to build 28 by the end of this year, and it's huge. Yeah. To what extent are you weighing up those? Are you moving funds from that commercial space, the office space, and redeploying around data centers, and how long does that last, do you think?
Yes. So talk about real estate, and obviously, as I mentioned, our real estate portfolio as a whole has kind of gone sideways a little bit for 5 years. Office has taken a hit, but that's been offset by actually good returns in office even in Asia, and then data centers and logistics have done okay. And the way we think about portfolio construction is we allocate to the real estate team, and they have a lot of delegation to find the best pockets. They have a lot of opportunity to invest into logistics and data centers. And actually, they have been building their logistics portfolio for a while now. And one thing I'd mention on data centers, which I think is really interesting, is At CPP Investments, it's really a collaboration between our infrastructure team, our real estate team, and our energy team. And they're all working together on the data center strategy.
Because you can't have one without the other, can you?
Can't have one without the other.
To power the data centers.
Power.
That's really interesting. Look, here in the UK, the pension model of Canada is often touted as something that we should replicate. The success of that model. Of course, CPP plays that crucial role within that. Is it replicable, do you think?
It is replicable, but it does take time. So we actually just celebrated our 25-year anniversary. So it was in 1997 that the Canadian government decided to create CPP Investments to have a professional money manager manage the surplus funds of the Canada Pension Plan, which is the compulsory program that all Canadians contribute to. And over that 25 years, we've grown the portfolio to $632 billion. And I think what's really important about $632 billion, 2/3 of it is from investment income. So really exposing that capital to the capital markets and just having it grow over time. And really at the heart of the success of the organization is the governance structure. Put in place a professional money management team that operates at arm's length from government with a sole fiduciary duty to maximize return without undue risk of loss. And that's really the secret sauce.
The governance structure is the secret sauce.
Yeah.
You talked about APAC and the relative resilience that's come through within commercial real estate for you from that region. Is there a region that stands out to you right now that is a screaming opportunity, or at least that you want to increase exposure to? Is there a part of the world that you think, yeah, we need a bigger footprint here?
I think like many people, obviously Japan has become a higher priority over the past few years, and India. And we've been in India for a while, continue to look for opportunities in India, building out our infrastructure portfolio in India. But again, never get too excited about a region, never get too excited about an asset class, and look for those opportunities in those two countries.
Okay, always through a sober lens.
Always through a sober lens.
It seems. John Graham, thank you very much indeed. Really fascinating. CEO of CPP Investments, on the opportunities, of course, the challenges in a pretty volatile world around, of course, private equity, credit and commercial real estate, and the regional lens as well. John, thank you very much indeed. Coming up, Italy's big EU role as the EU tries to strike a deal on top posts. We're going to look at what they can offer new kingmaker. Yeah, it's Giorgia Meloni. The details on that next. This is Bloomberg. Welcome back. Now, UK opposition leader Keir Starmer says he will target 2.5% economic growth if the Labour Party comes into power in next week's general election. Yes, it is next Thursday. But economists, including the influential Institute for Fiscal Studies, says that it is not credible to believe that growth will come so quickly. Let's speak to Anand Menon now, Professor of European Politics and Foreign Affairs at King's College London. And Anand has views on some of the policy measures that are not being discussed, at least not in the detail that you'd like to see across this political spectrum that we're seeing as we lead up to this vote. So we'll get to you on that. But first, in terms of the polling, because it's consistent, relatively consistent in terms of there's 20-point lead or thereabouts for the opposition Labour Party. There's always a risk, of course, that the polls get these things wrong. We know that there, by some estimates, are up to 5 million people undecided across the electorate. How confident, what is your level of confidence in terms of the polling and in terms of how things play out post-July the 4th?
I mean, what I would say is we could have the biggest polling mistake ever and Labour would still win by a comfortable majority. They're so far ahead. So I'm relatively confident in that sense because not only have the polls been consistent in the campaign, they've been consistent for months now with that 20% lead. And yes, there are uncertainties. There are uncertainties about the don't knows. There are uncertainties about turnout. So there can be some wrinkles, but the scale of the Labour lead, I think, makes it
so pretty... that 5 million in terms of undecided is not a wild card in your view?
I mean, it is a wild card because obviously it will help determine the size of the majority. And there's a heated debate about whether the majority of the don't knows are Tory 2019 voters. And there's a big debate amongst pollsters about how we should assume they are going to vote if they vote at all. But my point is, such is the scale of the Labour lead that Labour look nailed on to win this election.
And by a majority. That's
by a
your
majority,
assessment at this point. Drawing on your experience, you see a solid Labour majority. What is that, above 200 seats or around the 200 seat mark? Do you have a kind of a number in mind? What are you
That's where the uncertainty comes in.
Okay.
Because so much of this, at the moment, what is striking about the Labour vote is it is incredibly efficient. That's to say, they are doing well where they need to do well. They're not doing so well where they're already sitting on very, very large majorities. if the night goes really well for them, and really well involves them being efficient, it also involves reform, picking up Tory voters in constituencies where reform is strong. It involves the Lib Dems doing very, very well in seats where they're competing with the Tories. It could be a massive majority, but there's a lot of moving parts behind that.
Well, as you bring in the Reform Party and the Lib Dems, let's go there, because the Financial Times has a story today about the fact that the Labour and Conservatives combined on course to register their lowest combined vote share in a century. What does that signal to you then about how the political landscape here in Britain is changing and shifting?
Well, it's been changing over a long period. If you think back to 2015, UKIP, which was the sort of forerunner of reform, picked up 4 million votes. The thing is, because of our electoral system, those 4 million votes only yielded one seat. So this fragmentation...
First past the post versus proportional representation.
Absolutely. Yeah. So this fragmentation has been going on for a while. The large parties were losing vote share in the run-up to Brexit. And then what happened was the two Brexit elections we had, 2017 and 2019, consolidated them. So in a sense, what we're seeing is a continuation of a trend that started well before 2016.
OK, that's really interesting, with the context on that front. We talked about the target for Keir Starmer, saying he wants to see 2.5% growth for the UK. And then the Institute for Fiscal Studies, critical of both Labour and the Conservatives in terms of not giving enough detail as to how they get growth back and how they fund it. You've talked about key policy challenges that have not yet been properly addressed. What are those?
Well, for instance, I mean, just taking up the line from the Institute for Fiscal Studies, both parties have been very, very quiet about some incredibly difficult decisions that await them after the election. Baked into current spending plans are enormous cuts to unprotected departments, including justice, and we've had news this week that the prisons are full, so actually whether we can afford cuts in that area is an open question. And to keep to the fiscal rule, whereby debt doesn't rise as a proportion of GDP, to avoid raising taxes, the only option is more cuts. And so what the IFS is saying, I think, is there's a lack of honesty here, because most people suspect that whoever wins this election is going to have to come in and raise some taxes or face some really unpalatable political decisions about cuts.
Some would suggest, maybe someone's within the Liberal Democrat Party, that one way to boost growth would be a closer relationship with the EU. Labour have consistently ruled out customs union, single market.
Yep.
They've ruled that out. Is that still politically rational at this point? Does that still hold up over the term of the next government, do you think?
Well, it will hold up in the term of the next government because it's written in black and white in the Labour manifesto. We will not join the single market. We will not join the customs union.
You take them at their word on that?
I take them at their word on that because it's in the manifesto. Now, there are ways around it. You could say we're going to sign up to a customs union. I suspect they won't do that, but the sting in the tail of that is it is with the customs union and the single market that you might see real growth. The sorts of things Labour are proposing with the European Union might be useful in avoiding and reducing border frictions. They're not going to make a meaningful difference in terms of growth.
OK. Before we let you go, on what's happening in France and Italy, so the shifts that we're seeing across European politics, and we're laser focused, of course, on what's happening in France, but Bloomberg also reporting today that Italy is going to, as part of this horse trading in Brussels, Italy will be given the option of choosing one executive vice president to be named to the European Commission. So only getting that as part of this negotiation, this bargaining, does that cement the far right in the EU's institutions? How monumental, how significant is that, do you think?
Well, the first thing of significance is that Maloney's group, the European Conservatives and Reformists, have done pretty well out of the election, so they're in quite a strong position. I think on the far right, they would argue they're being frozen out because, of course, the centrist politicians got together last night to try and stitch up a deal without Maloney being in the room. Now, she's pushing back and saying Italy's the third biggest European economy. Italy should be represented in these talks. So she's now saying we need proper representation in the European Commission. I think it's slightly unfortunate that this is happening because given the sort of anti-politics mood across Europe and the elections coming in France, it's quite easy for radical parties to point to what's happening and saying the same old people stitching up the same old posts despite the electorate voicing their discontent with the status quo. So actually it's not a very salutary sight, it has to be said.
Are you concerned about what's happening in France?
God, yeah, I think everyone should be concerned about what's happening in France because there is the real prospect, if not of a far-right government, then of a parliament lacking a functioning majority, which makes it very, very hard to govern.
Anand Menon, fantastic analysis on the politics of not just France and Italy, but of course the UK as we count down to the vote here on Thursday. But ahead of that, of course, the parliamentary vote in France, at least the first round of those parliamentary elections on Sunday. Anand Menon, Professor of European Politics and Foreign Affairs at King's College London. Thank you. Coming up, Violent protests in Kenya over controversial tax proposals leave at least 5 people dead. More on that story next. This is Bloomberg. Welcome back. Kenyan President William Ruto has hit back against nationwide anti-government protests that left at least 5 people dead. Ruto described the demonstrations as treasonous, and he's deployed the military to end them. The protests were sparked by controversial new tax measures to boost state finances. Let's get more now with Bloomberg's Ondiro Oganga joining us with the latest. Ondiro, walk us through then the events that have led to this.
Tom, through and through, the message has been the same from these protesters: reject finance bill, reject finance bill. This is a bill that they say will mop up the little liquidity that they have left, because times are really tough in the country. Unemployment is tough, the business environment is tough, and hence businesses are not making profit like they used to back then. But this pleas fell on deaf ears despite the fact that these protests were held nationwide. Parliament passed this bill and now it sits in front of the president. And while Parliament was doing this, there were some protesters that approached Parliament, breached gained ground on Parliament, and unfortunately police opened fire on some of them. Some of them were shot dead. International media was broadcasting, showing the lifeless bodies lying there. And these are really young people born in 1995, 1997 that have lost their lives. But in the last 24 hours, we've seen massacre unfold. In the evening, Bloomberg can confirm that nearly 17 people were shot dead in Githurai, and the National Hospital is appealing for blood. And that just goes to show you the amount of damage that was done in the last 24 hours in the country.
Yeah, indeed. Look, at this point, is there any indication at all that these planned taxes could be scrapped or at least reconsidered?
Tom, this bill right now sits in front of the president, and he gave no indication of that. Yesterday, he addressed the nation at 9 p.m. in the evening, and there was an opportunity to de-escalate, to extend the olive branch, but he did not do that. He was very bullish in his tone. And if you ask Kenyans, this ship has sailed. The finance bill was just a tip of the iceberg, but Kenya has deeper problems. It has spending problems, as some of these protesters have said. Day in, day out, the government says there's no money, but they see the government creating unconstitutional offices and funding them, dressing in designer, donating money in Sunday services, $20,000 all the way to $200,000. But doctors are not employed, teachers are not employed, and so we are likely to see more protests continue.
OK, Bloomberg's Ondiro Oganga on these protests and the wider challenges facing, of course, the Kenyan government and that economy and the people. Thank you, Ondiro. Let's check in pre-market on a couple of individual corporate names on our agenda today. Nvidia, after the gains of yesterday, gaining, of course, almost 7% after that 3-day rout, currently looking to build on the upside of yesterday. Currently pre-market Nvidia up 2.5%. European tech getting a lift from that story as well. Rivian, with investment around VW, also soaring pre-market, currently up 35%. Up next, Bloomberg Brief with Danny Berger and Manny Scranny. This is Bloomberg.